Welcome to It's the Economy. This week, markets are keenly awaiting the Reserve Bank of India's dividend. As per the budget estimates, it should be around 2.5 trillion rupees versus only 2.1 trillion in FY24. But there is a widespread feeling it is going to be more than 2.5 trillion. Reserve Bank, CNBC TV18 did a poll of economists, and that poll indicated the dividend may be 3 trillion rupees. Now, here's why the market is expecting a bigger dividend. Reserve Bank of India data shows that RBI has sold a whopping $415 billion in FY25, that is from April 2024 to March 2025. This compares with a gross sales of only $153 billion in the previous year. Now, every time the Reserve Bank sells a dollar, it will be at the current price, and in FY25 it works out to between 84 and 85 rupees. But its purchase price is the average price of all its reserves, and that works out to about 78 rupees according to some experts. So the Reserve Bank is making about 6.5 rupees every time it's sold a dollar in FY25. This means the Reserve Bank has made 6.5 rupees multiplied by $415 billion. That is 2.7 trillion rupees in FY25 compared to only 1.2 trillion rupees in FY24, because then it sold only $153 billion. So only on dollar sales, the surplus of the Reserve Bank of India in FY25 would have been 1.5 trillion rupees more than in FY24. And that's why we come to this figure of 3.5 trillion rupees dividend. Now, how much is the reserve market expecting? How much is factored in? What will be the impact if this is actually the announcement? For all that, I have with me two guests, Madan, Sabnavis, the Chief Economist from Bank of Baroda, and Rajeev Radhakrishnan, CIO, Chief Investment Officer, Debt at SBI Mutual Fund. Madan and Rajeev, thank you very much for your time. Madan, your math, I think when I did the poll, Madan's entry was 2.5 trillion. But do you think that it can also be 3.5 trillion?
See, I think it can go probably towards 3 lakh crores. So 2.5 is more conservative. So in fact, I have not looked at this particular calculation which you have put on the screen. So I think if it does work out that way, we could go closer towards 3 lakh crores. Because we should also remember that interest rates have also been high last year, which also means that the RBI would have been earning higher income in terms of interest income on all the treasuries which were purchased by it. So on the whole, I think it's a very positive sign for the government, because any kind of income for the Reserve Bank of India, given ceteris paribus conditions for expenditure, would actually mean that there would be a larger surplus. And to that extent, it will be helping to shore up the fiscal deficit. And in case things go according to plan on fiscal deficit, I think this will be a kind of a buffer which it has for any kind of contingency expenditure which could come up during the course of the year.
Okay. Rajeev, you want to come in on dividend? What are your calculations?
Yeah. No, as you said, the budget numbers are somewhere close to 2.2 or so when you look at RBI. 2.2 to 2.5 possibly is what is there in the budget. But the market is clearly looking at around 3 at least. So I think any number below 3 trillion should be a disappointment from a market perspective. And more so after last week's announcement where the RBI was supposed to have relooked at this buffer, there is clearly an expectation of a number which is around 3.5 trillion. So I think that's the range of numbers that are floating around in the market at this point in time.
Okay, no, Rajeev, the expectation was the 2.2 trillion you say is right, because in the budget entry it is 2.56 crore
2.5, yeah.
for 2.56 lakh crore for RBI plus PSU bank dividend.
Yes.
So, I mean, the estimate both of you are mentioning per budget is correct. But if you look at this dollar sales, it is whopping. And especially in Jan and Feb, each month they have sold something like 80 billion, 60 billion. So it clearly looks like once the budget was getting ready, the RBI was preparing to sell more dollars, and they buy back the same amount every month. So it is clearly intended, or so it seems, to show a higher dividend. Madan, would you say that right now, even if you monetize the deficit to such a large extent, 3.5 trillion, there is no worry because inflation is anyway low?
Yeah, I don't think there's any worry. In fact, I think it provides a lot of comfort to the government because whenever a budget is drawn up, it's drawn on very conservative basis. And there are always these expectations that there could be slippages. It could be on capital expenditure. It could be maybe on some additional expenditure which may have to be incurred. So that's why we have these supplementary budgets coming up during the course of the year. Now, even in terms of revenue, if today we are talking of GDP growth in the region of, our forecast is 6.4 to 6.6, which is again very, very conservative. Now, if there's any slippage in terms of GDP growth, there could be a shortfall in terms of tax revenue. So now when we're talking in terms of the Reserve Bank of India contributing to, say, or 3.5 lakh crores, anything above, say, 2.2, 2.3 lakh crores is definitely going to be a bonus for the government. It becomes that much easier to handle the overall fiscal numbers, given the fact that the government has said that it's committed to the 4.4% number. So the slippages which could possibly arise on account of revenue shortfall or expenditure being higher than what was projected is actually buffered once you get this kind of an amount from the Reserve Bank.
Yeah. Actually, with what is staring us in the face is a higher defense expense. Every day, our correspondents from Delhi are reporting that replenishment of resources expenses are soaring already, and the three chiefs of Army, Navy, and Air Force have been given enough powers to requisition more of spares in particular. So maybe it will come. I mean, I'm putting all this together to justify this 3.5 trillion rupees. But Rajiv, what is factored in? If it indeed is, say, on May 23rd, the RBI announces 3.5 trillion, do you expect bond yields to fall further?
Yeah, so with 3.5, I think after last week's statement from the RBI that the board has reviewed the framework, clearly 3.5 trillion, north of 3 is something that the market possibly is looking at. And with 3.5 trillion, I think that should be a positive news. But, very clearly, a lot of that is possibly there in the price, right? With the benchmark, the new benchmark almost close to 620 odd today. I would say a number close to 3.5 trillion is clearly there in the price.
Okay. Well, I think that point needs to sink in. We are seeing the new 10-year at as low as 6.2. And I think that is a number we saw, in 2019 or 2020, isn't it? Isn't this a 5-year low?
Yep.
Okay. Well, Madan, what's your sense? How low can the 10-year go, not just now, but this year? What are you looking at?
So actually, it will all depend upon how low the repo rate goes. Now, we are looking at another 50 basis points cut in the repo rate. That is, we go to 5.50. And that is based on the premise that we have an inflation of 4%. So even though I think this 3.2% number, which came for April, has made a number of analysts feel that inflation could probably be much lower than 4%, I would still think it will be in the region around 3.8, 3.94%. And going by the RBI's thing of real rate of 1.5%, so 5.5% looks fair enough to me. And if I have a 5.5% repo rate, I think it looks likely that the 10-year yield could go up to 6%. So, but I think in case there's any acceleration in terms of accelerated reduction in the repo rate, or maybe more than 50 basis points, which we don't believe will happen, but yes, it's definitely a possibility, then I think we can even go less than 6%. But as of today, looking at 50 basis points cut in repo rate, by March, I think the 10-year yield should be in the region of around 6%.
Okay, what's your sense, Rajiv? There is the expectation, that the Reserve Bank on June 6th will even lower the inflation forecast from 4 to 3.8, because the first 4 months are giving us, an average way below 4%. And it's expected to be even lower in the coming months because of the high base as well. So what is your total repo rate end rate, and therefore your 10-year expectation?
Yeah. So I think that's a very important point, because our earlier expectation was clearly that the policy repo rate should top off at 5.5 in this cycle. But as you mentioned clearly, I think it's an evolving situation where on the growth side, if any, you possibly have downside risk. And when you look at where the inflation numbers are likely to pan out, quite possibly that the RBI may at some point look to revisit their inflation number of 4. So I wouldn't be surprised if that were to happen over the coming few months. So So with a 5.5 estimate of where the policy repo rate should go in this cycle, somewhere close to this 610 should have been the range where I could have said that this is where I think the 10-year will bottom out in this cycle. But I think the important thing is to know that as we go forward, quite possibly the policy rate cut expectations can get reset in terms of how much further we can go in this cycle. So I think that's something that will clearly be a factor that we need to look at over the next. And I would be surprised if
you're not buying 3 rate cuts already, Rajeev?
No, right now I think it's still 5.5 for me, but I think we need to see some more data, which possibly would lead us to revisit where the policy rate goes in the cycle. Okay. So I won't be surprised if it can go even lower.
3/4. Okay, 5 to 5/4. How much will be the US yields a factor, Madan? US yields are stubborn at 4.5, and the bill that is pending before the House and was not passed is only going to increase the debt burden of the United States. So if the US yields continue to be at 4.5, the 10-year, the benchmark, will that be a factor at all?
Yeah, in fact, Latha, I think that's going to be one factor which is going to ensure that the 10-year yield in India doesn't go significantly, doesn't really crash to something below 6%. Because what we have seen is that historically we have seen a difference of 250 to 300 basis points being the difference between the US Treasury and the Indian 10-year yield. But today we're talking of this thing actually getting narrowed down significantly. So this 4.5% will remain, I think, in that particular region. We're looking at 4.3, 4.4 for the US Treasury until there's more clarity in terms of the entire tariff episode, which started in April. And as long as we remain in this region of 4.3, I think our 10-year yield will probably continue to be in this region of 6.10, 6.2, and maybe towards the end of the year, we go to 6. But definitely this thing of 200 basis points, the difference between, moving away from 250, 300 basis points is not something which can be sustained for a long period of time. We will finally have to gravitate to that. Either the US yields have to come down or our yields will have to stabilize more in the upward.
Okay, Rajeev, would you agree with that? Because until now, we gave a lot of importance to this interest rate differential. But now 2 things have changed. Our inflation rate is not very different from the US inflation rate. It's only 1 percentage point higher. Time was when it was 5 percentage points higher. US was going at 0 and we were going at 5% at least. Plus, have you noticed any change in FPI bond investments because of this interest rate differential declining? They seem to be coming all right.
Right. I think I would not really attach, too much of importance to the interest rate, differential that you just mentioned. It's of course a factor to the extent that now we are more open to bond investments, given the FAR, the route which is quite clearly available for overseas investment. But in a situation where the 10-year Treasury yields stay where they are, given the fiscal and other issues that the US is facing at this point in time, you should not really expect that you will see large, debt flows into our markets. So that's not something that is, I would say, very, very important in terms of determining where our bond yield eventually go to. Because I think that's going to be largely a function of domestic growth inflation dynamics and domestic demand supply dynamics as they pan out. So that is quite favorable at this point in time in terms of where our bond yields are likely to move. So I'm not really so sure that this interest rate differential really sort of matters in terms of where our bond yields should eventually settle.
Okay, at the moment, of course, the US is also grappling with the downgrade of debt. Not that it was new, it was already done by the other rating agencies. A third one has followed. Out of time, but thank you very much. The key takeaway is that we could have a higher dividend and we could see the Indian 10-year go all the way to 6%, and some are even expecting it to go below 6% by the year end. Wrap up on Bazaar on that note. Chart Bus is coming.